Imagine this. One of the most powerful and secretive companies in the world is quietly shaping the future of space communications defense and global connectivity. And most people are only now starting to realize that something big may be coming. There's growing chatter that SpaceX could eventually go public around 2026. And if that happens, it could become one of the most talked about IPOs in modern financial history. So stay with me until the end of this video because I am going to explain how people are trying to position themselves today before any potential listing, what is real, what is hype, and how to think about this opportunity with clarity instead of emotion. Right now, a lot of eyes are on SpaceX, not just because of rockets and Mars dreams, but because of recent developments around Starlink revenues, new government contracts, ongoing regulatory negotiations with aviation and communications authorities, and Elon Musk's broader ecosystem of companies which continue to influence public markets, even while SpaceX itself remains private. In recent months, SpaceX has continued to secure major launch contracts with governments and defense agencies. Starlink has expanded aggressively into new regions while navigating tighter regulations in Europe and parts of Asia. And Starship testing has remained under intense scrutiny from regulators as SpaceX pushes the limits of rapid innovation. All of this fuels speculation that when SpaceX eventually lists, demand could be enormous. Before we go further, if you want clear thinking about markets innovation and the next generation of wealth creation, subscribe now to the channel The Next Gen Mentors and activate the bell so you do not miss what comes next. Here is the key question most investors are asking today. If SpaceX is still private and has no public ticker, how can anyone realistically get exposure now? If you open your brokerage app and type SpaceX, nothing appears, there is no ticker, no direct listing, no easy button. There are private secondary markets and special purpose vehicles that sometimes allow accredited investors to access SpaceX shares, but those usually require very high minimum investments, long lockup periods, and legal complexity that makes them unrealistic for most people. So, for the vast majority of investors, the only viable path is indirect exposure. The first and most concentrated public proxy is a closed-end fund called Destiny Tech 100, ticker symbol DXYZ. This vehicle is designed specifically to give public investors exposure to late-stage private technology companies. It holds a basket of pre-IPO names such as SpaceX, OpenAI, Stripe, and other private giants. It does not hold SpaceX as a simple line item. Instead, it owns special purpose vehicles whose sole purpose is to hold SpaceX equity. When you look through the structure, a very large portion of the fund's net asset value is linked to SpaceX, at various points estimated to be anywhere from roughly one-third to close to half of the portfolio, depending on valuation updates. That makes DXYZ the most SpaceX-heavy public market vehicle available today. Now here's the mentor perspective. This is where many people stop thinking critically. DXYZ almost always trades at a very large premium to its underlying net asset value. In simple terms, you are often paying far more than the actual paper value of the assets inside the fund. On top of that, it carries high management fees and additional costs from the special purpose vehicles themselves. This means you're not just betting on SpaceX succeeding, you are also betting that enthusiasm stays high enough to justify that premium. If sentiment cools or the premium compresses, the share price can fall sharply even if SpaceX's private valuation continues to rise. This is why, from a disciplined investing standpoint, this type of vehicle should only ever be a small speculative position, not a foundation. The second route is a more balanced option, an exchange-traded fund called the ERSHARES, Private Public Crossover ETF, ticker XOVR. This fund blends publicly traded growth companies with limited exposure to late-stage private firms through special purpose vehicles. SpaceX exposure here is much smaller, typically around a mid-single-digit percentage of the portfolio. This means that for every dollar invested, only a small slice is tied to SpaceX, while the rest is spread across innovative public companies. The advantage is structure. XOVR trades close to its underlying value, has lower fees than closed-end vehicles, and does not rely on massive premiums to justify its price. From a business mindset perspective, This is a way to participate in the innovation theme without making your entire outcome depend on one private company. The third and most dramatic option is a public company called EchoStar, ticker SATS. Through a series of spectrum and satellite agreements, EchoStar ended up receiving SpaceX equity as part of strategic compensation. Public disclosures suggest this stake is a low single-digit percentage of SpaceX. At the private valuations being discussed recently, which range in the hundreds of billions and in some conversations even approach the trillion-dollar mark, that stake alone is worth billions. This is why the stock has shown extreme volatility as SpaceX headlines emerge. But here is the coach's warning. SATS is not a pure SpaceX tracker. You are also buying a capital-intensive satellite and telecom business, with debt, operational challenges, and competitive pressure. This makes SATS behave like a leveraged option on SpaceX, layered on top of a complex operating company. When SpaceX optimism spikes, the stock can surge. When the core business struggles or the narrative shifts, it can fall hard regardless of SpaceX progress. So how should you think about this as a rational investor? If SpaceX does go public around 2026 and enthusiasm explodes, those who already owned exposure through these vehicles may benefit. But that does not mean chasing every product that mentions SpaceX is a smart move. From a mentor and business perspective, this should all be framed as a speculative sleeve, not a core allocation. DXYZ is the highest risk, highest reward structure due to its concentration and premium. XOVR is a more diversified and controlled way to get indirect exposure. SATS is a company-specific bet where both SpaceX valuation and business execution matter. The upside story is powerful. SpaceX dominates global launches, Starlink continues to scale recurring revenue, defense contracts deepen government reliance, and Elon Musk's brand keeps attention high. The downside story is quieter but just as real. Premiums can shrink, fees compound, private valuations can be revised, and operating businesses can disappoint. My philosophy is simple. Wealth takes time. There is nothing wrong with having a clearly labeled moonshot bucket in your portfolio where SpaceX-related ideas live. Just make sure the foundation of your financial life is built on diversified, liquid, understandable assets, not just a rocket and a hope that an IPO will fix everything.